we just open it up, and I've got booked aside 90 minutes. And if you've got 90 minutes worth of questions or 290 minutes, that's all good too. So whoever wants to see, you'll do it by raising hands. Is that the best way? Everybody hit the raise their hands button and you can good to go. Anything and everything is on the table. So let her rip.
All right,
Josh.
Josh.
All right, I'll kick us off. I often hear about how the first year financials are worse than expected post close. You know, J curve and all that, things you didn't know, all the different issues. My question, I'm sure it's hard to give a general answer, but like, how bad should I expect? And I know it's case by case, but like, what's the pragmatic or kind of realistic way to not have rose tinted glasses in the first year of financial outcomes?
It's a great question. And there's two parts of really, or a few parts the way looking at it. And I think we've mentioned before, when I calculate working capital or what I may need to inject into the business as a start, because sometimes you can negotiate working capital, other times it doesn't meet your requirements. I get ridiculously conservative and I calculate a 25% decline in the business before everybody grabs their head. That's strictly for budgeting purposes. I want to make sure that there's adequate capital set aside in the event that the business could decline substantially. But again, that's for budgeting. As far as what you can expect for a business that you take over, it's really all over the place. Oftentimes it doesn't decrease. And very often that's tied to the seller staying on board and having an effective transition so that the employees and the suppliers, the customers, nobody panics. If you negotiate too brief of a transition, even in the simplest businesses, declines are pretty common because you're really learning the business. And so while there's no hard rules of here's how much the business is going to decline, because it may not, it may increase, but so much is tied into trying to keep a very effective transitional plan into place. And that's why when you go through like lesson 23, and we talk about post-purchase priorities, the beginning, you do nothing. And so until you start to feel the business. So if you can keep the seller on board for a decent period of time, sometimes it's 30 days, sometimes it's 6 months, the longer you keep them, if they're cooperative and collaborative, the more mitigation you're taking against a decline. That's really the barometer. Now, sometimes you buy a business and the owner's just a complete pain in the ass and you can't wait to get rid of them. So you have to just understand, get as much information as you can related to operating the business. And then if they start infringing upon policy, you find employees going and talking to them, that type of thing, you have to get rid of them. But if you can keep them for a reasonable amount of time, then the longer you keep them, just as far as teaching, usually mitigates the downturn.
Thanks.
Awesome. Okay, looks like we have Yanal next.
Hi there. Hey, Richard.
How
Sorry,
are you?
I'm driving again. Good. How's it going?
Great, thank you. Good to have you here. I can't say good to see you, but good to have you.
Yeah, driving again. So apologies if
No problem.
you hear some noise or I lose connection. But my question, the current deal that has piqued my interest right now is it's a behavioral therapy clinic, and it's been around for like over 10 years. Owner's retiring, and basically this is kind of like my first rodeo of like actually I reached out to the broker, or even before that, the broker's assistant, and got this like teaser information, I guess somewhat of a sim. And I got a call this week, my first call with a broker, and it went well. I
Good.
used all the material that you shared actually through your material. Yeah, like through the PDF. So I prepared myself with asking all the right questions, and seems like he was impressed, saw that I was a serious buyer, and he said, let's set up a meeting now with the owner. So after I provide some financial information. So I guess my question maybe, I mean, I have a bunch of questions, but we'll start a little bit high level of like, I mean, I don't know, have you ever kind of worked or advised on any of like therapy clinics? Any thoughts there? You know, like basically just to give you a little more context, like she's owner and she's also a therapist. She's kind of stepped away from the job of therapy and tried to do more of the operations, like day-to-day invoicing and accounting. So obviously that's like a big risk of you know, her being a therapist. And you know, my major concern is like, okay, someone like me coming in who's not a therapist, like would the customers just leave? It's like, who's this new owner? So that's like a big thing I was thinking about. But just, yeah, high level, I guess. Any thoughts on like this space at all? If not, I could kind of get to something more specific after
Okay.
that.
So as far as my experience with therapists are concerned, if you'd speak to my ex-wife, she probably will tell you that I should be in therapy. But other than that, my direct that I could pretty much bet you that. As far as yes, they're very similar to professional practices. Like you could lump in accountants, attorneys, dentists, doctors, and therapists, and mostly doctors, dentists, and therapists. A little less so attorneys and accountants. And if anybody's looked at those businesses, I could talk about those separately. But for the sake of what you're looking at, these businesses, if you are not a therapist and this business, if the business has any ties to the current owner therapist, meaning that her name is on the door and people are coming in that may have started their therapy as a result of this individual, it's a very difficult transition. It's a very difficult transition to another therapist. It's an incredibly difficult transition to someone who's a non-therapist for several reasons, which include the fact that understanding the relationship between the owner and the current therapist who are providing the services, unfortunately, you'll have an inherent lack of respect from the individuals as far as I'm concerned, because it's very hard to be in a boss position if you haven't done their work. So it's similar. It's actually more fragile than what happens in some professional practices. You see this in dentist offices. If it's very easy for people to leave, there's no guarantee that they'll stay. And so these businesses, if there was a good fit, then what happens almost always is these are based on an earnout, meaning that it's based upon the retention of the clients. Now, in therapy, what I need to understand is therapy is a little stickier than a dental practice or a general practitioner, even some accountants that just do tax return. And just give me a thumbs up or yes or no, if she's doing more administrative, is she seeing any patients?
From what I got from the broker, like she stepped away from it. And her name, going back to your question, her name's not on the name of the company. So like it's mostly like the other therapists kind of bring in their customers, and it's like word of mouth. She built up a reputation, a strong reputation in the neighborhood. So it seems like at first glance, like there's not a huge risk in that. Like everyone kind of operates independently. Like the therapists are on a part-time basis because some are going to school, from what the broker said, and they need some time to study, obviously, to get their credentials.
Okay,
of
so
what
let
it
me
is.
let me interrupt you for a second because I want to cover it off
Sure.
that big question, because certainly if there's a lot of detail, we can go into it question by question or separately. But just you're talking from a 30,000-foot view, it's very important to understand why those people come to that particular practice, and how easy is it for those therapists, part-time or otherwise, to leave. What you're trying to get to is the stickiness of the business. If it's very easy for patients to leave with their therapist or the therapist to leave, then then there's exposure. And so if you determine that the business makes sense for you and it's not, the assets of the business don't reside with the owner, her name is not on the door, she doesn't have any patients, and that's critically important, because if she has any patients, all that revenue is going to likely disappear. That's the way you have to factor it. It may be taken over by some of the other therapists, but for the purpose of your exercise and valuation, you make the assumption that all that revenue is going to disappear. And so what you have to get to is how sticky this business is. In other words, how easily patients are less inclined to leave a therapist than a therapist is to move to another facility. So unless there's something that's just not working between the therapist and the patient will likely stay with that particular therapist, those individuals that you said, students and otherwise. It's the question of, will the therapist stay? Because that's all you're doing in this business is you're selling and managing labor. And so getting to how they stay is going to be really, really important. And it mostly become from a communication standpoint, and where you need to dig in is to find out, why do these therapists stay at this facility or work out of this facility? And that's what you have to dig into a little further.
Got it. Okay, that's helpful. Yeah, the initial thing was that they get paid better than like other areas, but I guess that needs to be verified.
Yes. Yeah.
Okay.
So verify this, you want to verify this, what we call the stickiness. And in this case, it's unlike a dental practice where people leave and go to other dentists. A therapist it's a very close connection between a patient and a therapist, and so the patient is much less inclined to leave versus other professional practices. So you have to focus on whether how sticky the therapist is and for why.
Got
Okay.
it. Thank you, Richard.
Well, my pleasure. And again, if there's anything further or deeper you got to go into, I mean, we can do it offline or come back once we do a little bit of roundabout and questions.
Sure. I'm gonna drop off, but I'm gonna come back in like 30 minutes. So hopefully you guys are still on, but if not, it's okay. Thank you.
Okay, nice to see you.
So just want to add on to that there was a comment that was made by Josh. Some states have laws prohibiting non-medical owners of medical
Great point.
Practices. Not sure if that applies here.
Great point. Yeah. It depends if they're therapist or psychiatrist. Absolutely great point, though.
And then also Dixon adds, you also need to confirm if the business license is in the name of the owner, because if she's a therapist or not.
Yes, and good. You guys are getting smart all the time. That's great stuff. As a matter of fact, it's a very good point as well, Dixon, because sometimes each individual person has to be licensed. Some states they can fall under the umbrella, like a real estate salesperson falls under a broker, versus other times, and there could be apprenticeship. So there's quite a bit to dig into. But great point, guys.
Excellent. So we have Jemiah next.
Hey, how's it going, everybody? Sorry for the camera being off. I'm driving as well too. Quick question, Richard. As I told you previously, I'm in the phase of about to start calling potential sellers, and the ones I'm calling are their business isn't for sale, but I do want to call to start kind of potentially see if they're willing to sell it. So, is there a go about to besides asking them, how's business, how'd they get into it, what keeps them up at night? Is there a other series of questions that you recommend without trying to get more information without them, feeling like they got to be more secretive versus someone who already have their business listed with the broker?
Got it. So great question. Two parts to the answer. One is we did a whole webinar on preparing for and meeting with the seller, and we broke that down into meeting with sellers whose business is publicly listed for sale and meeting with sellers whose businesses they're off market, because it's two completely different approaches. You want to go in there. I prefer to go in there in those situations with no questions, just to have a general conversation, because you don't want to put them off at the beginning. They're not prepared for anything. They have no idea how this process works. This whole phone call comes at them from left field. So the introductory is very important to talk about things that you're looking for. You're looking to acquire a business in their industry. Is it something that they would consider? And then have a general conversation. And one of the things that's different when you approach a business that's not publicly listed, if you recall, when you go to meet with a seller, you always want to ask your questions first, because if not, they're going to tailor their answers to how you presented yourself. If they asked you questions about your background and interests, what have you. in the scenarios where you are approaching a business that's not on the market, you have the complete opposite approach. You tell them about yourself first. And don't be afraid to be completely transparent, because this is not only new to them, it's completely out of the ordinary. They're not expecting this. So just, here's a little bit about myself. I'm looking to get into this particular space. I'm looking at some acquisitions. Would you consider, on the right circumstances, potentially selling your business? And they're going to tell you, I mean, 90% of them will tell you, well, of course, if the price is right, I'll always sell my business. But you want something a little more meaningful, and then you want to have the opportunity to just meet with them and have a conversation. Getting to the questions is much slower when you're meeting with someone off market, because if not, you'll be perceived as a threat. But you also want to manage it in a good way to show them that you know what you're doing, because if you don't approach it in the right way, here's what happens. You call them up to seller, hey, Mr. or Mrs. Seller, here's, my name is Jemiah. I'm thinking about buying a business in your field. I'd like to have a bit of a conversation or introduce myself if it's something you would entertain as far as a conversation. And they say yes, and you have a little bit of good back and forth. And then if you don't demonstrate to them that you have a sense of how this works in a good way without being overbearing, the first thing they do is they're going to put down their phone and they're going to call their attorney and say, hey, I just got a call from someone who's interested in selling my business. What do you think? And they'll say, well, before you do anything, you should, you may want to speak to my buddy James, who's a business broker. And then they speak to James, and James said, oh, no, you don't want to do that. I mean, if you're thinking about selling your business, let's put it onto the open market, etc. And you blow the whole opportunity. So you've got to do it in a very methodical way, no pressure. Don't even worry about getting your questions answered, even if it takes 5 meetings to do it. But what I would suggest that you do is, I think, Sia, the webinar we call this Preparing for and Meeting with the Seller. I think that's the thumbnail, right? And it's one of the first ones, like this, probably the second or third webinar we did. Should watch it, because we lay out the exact process step by step, in addition to what we just talked about.
That is perfect. So more so, just like I'm building a relationship with anybody, just kind of be inquisitive, get to know them, let them get to know me, and let the questions naturally evolve.
First date, right? Like
Yes.
you're going on a first date. You're not ready to buy furniture, and you're not asking any of the intimate questions yet.
Perfect. Thank you, Richard.
Okay.
Awesome. We've got Irene next.
Hey, Richard.
Hello there. How are you?
It's good to see you. Thank you. I'm doing well.
Great.
I do have, I may have some audio issues. I don't know, but hopefully you can hear me. I was speaking to a lender earlier this week, and I went back with some of your earlier chapters of the material you put out, specifically about the pre-qual letter, right? And I know I've asked this of other lenders in the past, and all of them kind of throw their hands up and they're like, yeah, we don't do that. Like, we just don't do that. This guy told me the same thing. I was like, all right. Like, I'm like, well, what are your other, buyers doing? And he's like, I don't know. Can't do them for him either. But he said he could do like a confidence letter, where it just pretty much is a letter from a banker stating like, yes, she at least has the funds and, good credit score. So I know that was part of your book. So I'm curious as to like what you have heard from lenders about that.
We get most of them that I talk to are able to provide a letter based on your personal financial statement. And at least to the point, I don't know if there's anybody in the call who has letters from specific lenders, but
Yeah,
they should be able.
I have 2. I can share
And so
contacts
maybe
if
you can
people are
share them,
interested.
because
Yeah.
you just have spoken to the wrong lenders, but that's okay. That's the point of these calls. So maybe George and then Joe, if you can share who those were, that would be great help for Irene.
Okay, I saw it. Yeah, Live Oak Bank. Okay, and I think I talked to them a while ago, so I'll have to reach back out. So they do a real pre-qual letter, not just a confidence letter. Okay, that's interesting. Yeah.
It wasn't so much a pre-qual letter. It was very similar to a confidence letter.
Yep.
But in my purposes, I've used that with brokers, and no one's had any issue with that being more than necessary.
All right. Yeah, well, thank you all. And then one more question, if I may. For the personal financial statement, Richard, you also indicate that that's something you have prepared, which, I mean, I'm sure all of us have prepared, but I've never prepared to share that with a seller. Does that kind of give you a disadvantage if you're putting it all out there in terms of the financials you have,
It's a great question. If your financials are strong, it's a huge advantage. People have this misconception that if you turn over your personal financial statement to a seller and you have a solid financial statement, that's going to somehow influence how they think about the asking price. We don't care about the asking price. It puts you ahead of the whole crowd if you have a stronger personal financial statement, and you're not going to allow that to influence your purchase price or your valuation. So it's actually a huge asset to have a solid financial statement. And as far as sharing the information is concerned, if we're asking sellers for P&L statements and tax returns, we should be very comfortable giving them our financials. But it definitely does not hurt you in any way, shape, or form. If your financial statement is a disaster, then you want to work with someone like even like a Deb Curtis, who can really dig in and help you. I mean, you're not fudging it, but she'll help you figure out where there may be some additional assets. But there's no harm. I actually take the complete other tact when I look at if you have a good to strong personal financial statement, you share it gladly with a seller once you've exchanged information. And just as do you want George or anybody to give you any names with any lender?
They put some information in the chat, so I have your.
Oh, good. Okay. I'm not that sophisticated. I don't even know that exists.
Thanks.
Okay.
Thanks, Richard.
Okay. So
Thanks,
no
Joe.
problems. And thank you, George and Joe. That's great. Okay, Daisy, we're gonna put pressure on you to ask a question now.
To Dacia?
Yeah. Now, how do I pronounce your name properly?
You said it correctly the first time. It's Deja, but it's
Deja.
pronounced like if you were saying deja vu. It's kind of the same.
Deja vu all over again. Okay, Deja. Okay.
Yeah, so let me look at my little sheet here. So I'm going through the course. I'm like on page like 462 or something like that.
Okay, great. Almost home.
Almost. I'm like reading every single day. So something that I had here was partnership. And I believe you did talk about this in the course. Do you feel like it's a good thing to, work with a partner throughout this whole journey if it's your first acquisition, or should you go at it solo?
So I've had a lot of partnerships in my life. When they work, it's absolutely brilliant.
Yeah.
I mean, because really, like, you get the combination of 1 + 1 = wow, I mean, it's really great. But you have to make sure you're really aligned. And so when you're early on the process, maybe you and someone else, whether they do have experience or don't have experience, you want to make sure there's two things there's actually three, that you're aligned related to the type of business that you want to buy.
Okay.
What that criteria looks like, that there's agreement for what each one of you will do. So if you're both strong in sales, there's no real advantage unless it's financial. You want to be able to have divide and conquer, so you have different skill sets. Apologize, I'm going to put my light on so you guys can get a real good look at my kisser. There we go. So that's the second part. And the third part is, which is not number 3, it's actually number 1, which is making sure you get along with them fabulously and that you really like and trust them, because nothing goes sour like a bad business partnership, because it's got everything in a marriage plus money's involved all the time. And so you really want to make sure that you get along with this person, that you feel like, if you get attacked, you're going to go back to back and fight everybody else, that you won't be at each other's throat, that like you've got each other's back and you really like them and really trust them. Now, assuming that's the case, then, I mean, I'm all for it. Trying to count. I don't want to waste too much. I've had probably 5 or 6, 7 partnerships. And I mean, outside of one, I mean, they were phenomenal. But it was really, the relationship was nurtured for quite a while, because that's really important. So I'm a big believer, especially if you're two of you, that it's going to take the combined efforts financially to acquire a business, then, I mean, sometimes you need to do it. You just want to make sure you never want to not pay attention to the relationship. Okay. And the other thing is, if there's someone that are friends or family, you got to be very cautious about it, because your relationship is going to change. It's inevitable. Sometimes it gets better, sometimes it gets worse, but you need to be very mindful of it. But so those are the few things to consider. But if someone were to ask me about doing partnership, I would do wholeheartedly. I would do them again. I think, when they work well, they're phenomenal.
Okay, that's good information. And then my second question, I was having a conversation with someone the other day, and I want to know your thoughts on the consult for equity route, and how are there any negative impacts regarding taxes if you take that approach? Because that's
So in
what
other,
someone,
so in other words, if someone provides consulting to you during the process or consulting ongoing in the business,
no, like if I presented myself as a consultant, is there, because someone was saying something about like taxes and like something about capital gains taxes, and that's why he never did it because he wasn't sure about how you would be taxed or something like that.
so you're saying that if you own the business, if you get paid a certain amount of money from the business as a consultant from the business,
Yeah, so like let's say someone like you, for example, you had a business and I positioned myself as a consultant to get a percentage of your business.
oh, got it. Okay. So you would go, in other words, if you're going in to meet with a seller and say, hey, I'll come in and consult for your business and I want equity in the business
Yeah,
in lieu of getting paid for my consulting work.
yeah. Mhm.
Okay. So the way that it would work out for tax purposes, if you have equity, you're not going to, there's no issue related to capital gains until you sell the business and until that equity gets monetized. So during the time that you are getting consulting and you're getting equity in lieu of it, what I believe your accountant or the individual is telling you is that you're establishing your basis
Okay.
for the tax. And so there may be a tax consequence because you're going, and I believe you can defer it, meaning when you go into the business and the business is worth $1 million and you're getting 20% of it, well, your basis is $200,000. And if you sell it for $2 million, then it's 400,000 less your $200,000 basis. So it's how does that get treated? I don't believe I'm not, but I want you to verify 100% with an accountant. And if you want, we can have a separate call after you give me the details. I'll speak to my accountant for you. It's
Okay.
whether or not, if you get free equity in a business, because that's effectively what it is. You're getting it. It's free, but you're providing work. So if you are getting free equity, there could be an immediate tax consequence. If you're getting equity as a result of work, I believe that's deferred, and it's just your equity, and it's down the road. But I'm happy to verify it with my CPA if you want, once I understand the exact details of it. But I do believe because you're providing work and not getting it for free, that it would only happen. There's only tax consequences at the point that you sell.
Okay. Got it. Got it.
Okay,
I
but
will
feel
follow up.
free, email me and we can get on a call and I'll get all the exact details and I can find out for you in a day.
Okay. All right. Thank you.
My
Thank you for all
pleasure.
the questions I have for now. So
Great. Hold on. No other questions. Hey, by the way, I don't know if has anybody on this call gone to our YouTube channel, watches the videos sometimes. So you know the famous Dixon Quasiga? Does everybody know Dixon? There's a video on our YouTube channel about Dixon, and he's not on camera right now, and he'd probably be a little bashful, but it's the most amazing entrepreneurial story that I've ever heard in my life. And so
Dixon from Canada, is that Richard?
yeah, that's from
Okay,
Dixon, who
yeah.
came from Uganda to Canada.
Yeah,
So
okay. Okay.
yes, Dixon, you're famous, buddy. So
Mhm.
yeah, it's absolutely wonderful. And there's a guy in Canada, if I could
Oh,
disclose
thank you.
it, if I could disclose it to everybody, Dixon, about Wes. Are you okay if I tell everybody the story about Wes?
Please do, please.
So in Canada, the version of Shark Tank is called the Dragon's Den. It's the same thing as Shark Tank, but for Canada. One of the dragons is a guy by the name of Wes Hall, which is great because if you just move around the letters in a name, it sounds like we shall. It's great. So, but Wes Hall, he saw me on a podcast, Austin Peaks podcast, which was a 3-hour podcast. And I get an email from this guy. I don't even know who he is. And he got an email from a guy and he said, I just listened to Austin's podcast. It was 3 hours. And he tells me a little bit about himself. And sure enough, then I realized he's like, one of the Mark Cubans, right? Of Canada. And a very, 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 very good looking, sharp guy. Got the greatest sneakers in the world. If you look him up, his picture, and he's always dressed great and really got the greatest sneakers. So we start talking. He said, I'd love to connect, just to hear your story and vice versa. So we had a call together, him and I. This goes back quite a while. And it was really an interesting conversation. He came from Jamaica, no money, nothing. I don't even think he had shoes when they came over to Canada. And he's become a very, very wealthy man. And when Dixon and I did the video together, because I expressed in the video, it was like very emotional for me when he was telling me his story and wanted to get that message out because it's so inspirational. And after we filmed the video and did a great job, got it all edited, and we uploaded it, I sent it to Wes. I said, hey, you should watch this, because this is like when we did this very much reminded me of you, Wes, and your story, immigrant coming to Canada with like nothing and really in a short period of time, just accomplishing some outstanding things. So he watches, like I send him this email and the link, and the video is about an hour long. 90 minutes later, he sends me an email back. And he said, I watched the whole thing. It's unbelievable. I want to meet this guy. So him and Dixon have spoken, and they're meeting in September. And it's a great connection because I know I'm two incredibly entrepreneurial people, and I know they're going to end up doing some business together. So it's just a wonderful, wonderful story. So want to share that because we love hearing great stories. All right. Any other questions? Because I've got a few if you want. Oh, here we go. Okay, Cam, go ahead. We need your microphone.
Yeah, I just had this turned up. I'm looking at a business that I'm in Canada, by the way.
Where in Canada?
In Calgary.
In Calgary?
Calgary, Alberta. Okay.
Been there about 50 times. You can watch the game tonight?
Yeah, I'm very nervous about it. I spent some time in Edmonton, so my son was born there, so yeah, it's gonna be a nerve-wracker today. So
yeah,
looking forward to it.
It'll be fun.
I'm looking at a business potentially where it's actually in the US, and it's a bit of an interesting setup. And so it'd be interesting if I'm interested in the business as to how I would go about it from a lending perspective. If I was in Canada, it's pretty easy. Mind management here, assets are here. In this case, it'll be interesting. I've been talking to the potential seller for a while. But how does the US lending industry look at something like that, where the assets are there? Some mind and management is in the US, some is in Canada, potentially, depending on what I do with myself, of course. But any thoughts on have you come across situations like that?
Yeah. If you're the basic government programs like SBA lenders, if you are not a resident alien, you are not going to qualify. You're not going to get, you will not get an SBA loan. You have a much better shot of getting a commercial loan on the Canadian side. The chances on the US side, unless it's fully collateralized, are like close to zero.
Got it. Thank you. I just wanted to make sure I don't waste any time with the whole SBA.
Yeah, so don't approach any SBA lenders. The only way you could potentially do that is if you were a small, less than 20% partner and your partner owned 80%. If that's not the case, focus on getting the lending on the Canadian side.
Okay, super.
From an institution. Yeah.
Yeah. No, thank you.
My pleasure.
Go ahead now.
George, I think.
Hey, Richard. So yeah, I don't know if I have a specific question. I was going to give you like a quick update and just get if you have any words of wisdom or any advice. But
sure.
I've had quite a bit of a journey this year in deciding where the direction I'm headed. I did read your entire book. I think you're gonna not like some aspects of what I'm planning to do, but essentially I am looking at purchasing a CPA firm. Two owners are retiring, So, I know you caution against like being the business, working in the business versus on the business, that kind of thing. Definitely for the first year, I will be working in the business. The sellers have agreed to stay on through the end of next tax season. They've also, I plan on just going back to what you said about the therapy business. I will kind of pitch it to clients as a partnership. So I'll keep their names in the firm. So it'll be my last name and their last names together, and we'll transition clients over the next, 9 months or so. So I submitted the LOI this week, or a revised one this week. Expect an answer next week. Yeah. What's your like gut reaction or?
I like it. No, I
Yeah.
like it.
Okay.
Yeah, I mean, first, do they do a lot of advisory work, or they do a lot mostly tax work, like
It's
tax
mostly
returns,
tax,
tax and
which
tax returns?
yeah, which
Yeah,
I think like, I know about AI, the AI, it's coming for every industry and everything, but I think I can layer on like higher value, like tax planning or tax resolution and other related services over time. But yeah, so it's
yes.
a high volume tax business right now. Yeah.
People are going to be apprehensive about giving their tax returns to a computer. So that is going to take a little bit of time. I don't think AI is going to overtake that business instantaneously. So I don't think there's a massive threat. And especially, I think it's going to be less so. There's been a big migration of people that have gone to the HR blocks of the world from accountants, and that is, or TurboTax, and
Mm.
that takes care of that shift already. People that bring their work to an accountant, if they have any level of complexity, I believe you got a good runway of people, a good runway of time of people that are going to, want to stick with a human being to do their taxes, because it's really, really important. It's similar to a doctor or a dentist. It's like, if you go to a dentist, they tell you it's now a robot. I don't know how comfortable I would feel about doing that. So I think there's that sort of sense. I love the fact that the two owners are going to stay, and they're also going to stay past next year's tax season, which I'm assuming, if they do some corporate work, will take you into September of 2025, right? When people who have their extension. If the next tax season is going to be till April, do they do a lot of corporate work? Give me a thumbs up if it's a lot of corporate. So they'll take past the extension. So I don't have, you haven't said anything that gets me pissed off. So I'm okay. I think the way you've talked about it is good. I would, the name of the company, I'd put your name last. Okay. And you may, if it's Jones, Anderson, and Edwards versus Edwards, Anderson, and Jones, so I'd put your name last to start. And as long as you're okay, you don't seem like an egotistical guy, so I'm sure it won't bother you. Over time, you may want to drop those names or convert to a corporate name, the CPA firm or whatever, but put your name last on the door. And then over time, you may even want to keep it there, and you give them, and part of the agreement, by the way, is you make sure that you have the right to use their names in the name of the firm, till you decide not to. And you've got to check to make sure that there's no regulations regarding if they're gone. I think if they go, because people could most of the time protect their name, but if they go work for another accounting firm or whatever, so you just want to make sure the legalities. But it sounds to me, I'll put my glasses back on because I made some notes as you were talking. Names, they're staying on board. I don't have a problem. It's, if they're doing mostly tax, you could always bring in someone junior to help you take up some of the role. So I think if you manage the LOI or the valuation, well, the deal structure that is partly an earnout, hopefully. And if that's the case, I think it's all good. My pleasure. We can't hear you, George, but we're good, right? Anything else further? Okay, man. 2 thumbs up. All right. Even better. Any magical questions from the floor? See, the stuff that I see in chat, is that already taken care of?
Yeah, it's me mostly.
Okay.
And an exchange of information. So that's
No
helpful for
problem.
Irene.
Okay, so I have a couple of questions that came up this week. Maybe they'll trigger some other questions. I'll tell you what those words were, and if you guys think of anything or want to ask, just get your hand raised, and I'll stop. And we'll get right to you immediately. So I had an interesting conversation with someone this week. We do a little bit more LinkedIn outreach, and I'm getting some of these questions from searchers or have a question, someone, and I'm always happy to jump onto a call with someone. I had a conversation with someone this week, and they were telling me about a colleague of theirs who bought a furniture related business and said, well, and then out of curiosity, asked, how's it going? He said, well, they had a major customer concentration issue that they only found about after they bought the business. Okay, so now for those of you who have attended the due diligence webinars that we've had or have read through the due diligence section, my answer, and it was like a knee-jerk reaction, which was like, I was just shy of saying they're an idiot. It's like, you should have, like, that's something that is like next to finding out where they keep the coffee machine in the place. I mean, that should be one of the easiest things to find out about a business. Because unless it's a company, I've seen it where a case where there's 15 different companies, all part of one umbrella company that are all buying from a company. It was a little harder to put the pieces of the puzzle together. But customer concentration is the easiest thing to find out in due diligence, because you're going to be going through customer records and revenue by customer. There's those reports. I mean, they're very simple. This was a case of they didn't ask the seller. The seller is not required to tell them. And as we talked about in a prior conversation, is this individual thought they were really smart and they had a very strong financial background from a wonderful business school, which has nothing to do with buying a business, and they did their due diligence themselves. And so look what happened. Right. And it's no secret. And I could assure you that that one piece, like, it was inexcusable. And I was on a call with this person, and I think they were begging for some empathy. And I was saying, like, it's just inexcusable. Those are some of the easiest things to find out. And so the point that I wanted to bring up with everybody is the understanding that the seller is not required to disclose anything that isn't material. And so you ask the questions, they will give you the answers. They will make representations. If they know of something in the business that is material and they don't disclose it, they'll sign a rep and warranty. But understand, it's up to you, the buyer, to uncover those problems, not the seller to disclose them. But certain things are so easy as far as customer contact. That's why we hire professionals. The next thing was related to earnouts and SBA loans, and something we configured this week, which is the following. SBA, as we've talked about before, SBA will not approve of deals with earnouts. Everybody's familiar with that? And the fundamental basis to that is if you evaluate a business at $1 million and there's an earnout component and they're going to lend you 800,000 and there's an earnout component of that of 200,000, well, they're giving you the money. If that earnout isn't earned, what happens to the money? Like, you're not giving it back to them. So there's that one part, and the other part is they want to know what exactly the threshold is for what that earnout is going to be, so that to make sure you can continue to service the debt. But in any case, they don't allow earnouts. But we came up with a plan this week that seems to be going to work just fine, which is we tied the earnout to a seller note. And so the seller note was going to be about $300,000. It was going to be an earnout of about $300,000. So, well, we do this in the format of a seller note. It's going to be on standby for 2 years, which is perfect because it allows the buyer to have that measuring period for 2 years, because sellers want a shorter period to measure the earnout and buyers want a longer one. So we had, because the seller note is a standby scenario, meaning nothing gets paid on that note until 2 years into the deal. That's part of SBA criteria. And we had the note configured in such a way saying there's a note for $300,000. Here's the interest rate. Here's the terms. In the event that the revenue of the business is X percent, or is X amount, seller earns the note. If in the event the business is this amount less a certain percentage, the note gets reduced. And so it was a perfect way. It complies 100% with SBA financing because it's not considered an earnout. It doesn't increase the price of the deal. And so if you get into scenarios where earnouts or performance-based clauses make sense, you can do it that way with an SBA note.
Hey, Richard, can you guys hear me now?
Yeah, perfectly.
Yeah, I was going to say, I basically I'm doing the same thing in where it's $1 million business, $200,000 seller note. And my lawyer calls it a retention adjustment, but basically the principal of the seller note will be adjusted if revenue falls below a certain threshold, which for me, I have 90% of 2023 revenue. It'll be adjusted, and I included in the LOI the fact that the offering price was based on a revenue multiplier of 1.06. So for every dollar below the threshold, the principal will be adjusted by $1.06.
Perfect. Absolutely. And a good multiple, by the way. Well done. That's a
Yeah,
good
thank you.
multiple. Yeah, really well
And I have
done.
a 1-year standby, but
That's okay.
Yeah.
Are you doing SBA financing?
yes.
And your SBA lender is okay with a 1-year standby?
I've talked to two, and one was fine with it. Do you think but I plan on going with a different one, so I guess
Verify
I
it, 'cause
haven't gotten through that yet.
yeah, most of them are 2 years. So all I would suggest is tell the seller when they come back, if they talk about the standby, they're going to say, well, we're not sure we want to standby for 1 year. Say, well, that's the good news. The bad news is it may be 2 years. Say it depends on the lender, will dictate it. And you can, to give them some comfort, say, look, if everything, is similar in scope, you'll be willing to go with the lender that offers the lowest standby period.
Yeah.
Notwithstanding that, you need to make the seller aware that it is entirely possible that the standby period may be extended, but that's not your doing, that's the lender's doing. I wouldn't worry about getting into it now until you hear the response on the LOI. But it sounds like you negotiated a very good multiple and
Thank
a good earnout. And 90% is terrific as a threshold.
Yep.
Great. Okay,
Awesome.
I think we got Joseph's got a question.
Yeah, I think, Richard, to your point there in terms of not bringing up the standby, what is the best way if you know? So one of the uses of the standby I know is to how that count towards equity in an SBA deal. Should you be utilizing that upfront in the LOI, or should you be talking about that and being able to blame the lender on the back end?
B, and blame the lender. Always blame the lender. Blame SIA, blame everybody else. Don't blame the buyer, blame the broker. No. And so the way you want to structure an LOI or a presentation that you're going to go get outside financing, okay? And the terms and conditions are subject to outside financing that are acceptable to you, the buyer, okay? And so when you get into discussion, if they get into any of the details, say, I'm going to try to get the best deal possible. I'm happy to share the information with you. I don't have any secrets, but understand there's certain terms and conditions that are dictated by the lender. I'm not negotiating. I can't negotiate. The lender's going to provide those terms, and unless you know them specifically, I would omit them. I would not include those in an LOI, except, as mentioned earlier, except to state that the deal is predicated or based upon, subject to, or contingent upon, whatever verbiage you want to use, obtaining third-party financing acceptable to the buyer.
So in that way, when you say it would be financing plus a seller note at X percentage in the LOI, that's where you would leave it. You just say 10% seller note. You'll even say amort and rate in there.
No, because it's going to be standby, and you're going to say, well, the lender's going to dictate. If they bring it up, certainly that the lender who's lending the bulk of the deal, they're going to want to be in first position. We know that. I mean, I always table that with a seller saying, like, this is like almost like, like dumb easy. We know that, but just leave it. Yes, put all the onus on the lender. And you could tell them, and I'm, never be afraid to share the terms of the of financing with the seller and say, here's what I got. I'm not hiding anything from you. This is what I've got. So it's it's not like I'm doing anything behind your back, or I'll go through the best, most favorable thing for me. But at the same time, I don't want you to get hurt. So if I can get a lender that doesn't need a standby or has a 1-year standby and it costs me 0.5 point more in interest, I'll do it. There's no problem.
Yeah. And then typically seeing the seller note defined in terms of rate and amortization within an LOI? Or
yeah, most of the time. Most of the time, X%, X number of years.
Got it.
Leaving off the standby piece. As long as you have the lead lender contingency in there, subject to financing acceptable to the buyer, you're fine.
Got it. I did hear also an interesting alternative thought process on how to do an earn down. If you're doing a stock sale, I guess the new SBA rules, and subject to confirmation, allow that if the seller holds onto some equity, they can organize around that and do a special distribution, which effectively makes it an earnout.
Yes, you can do that. If the seller retains equity, and you don't necessarily even have to do it as a stock sale, even if you do an asset sale, if the seller retains equity, what you can do is you can have the equity subject to dilution.
Yeah.
Meaning they retain 10%, but if the business doesn't do X dollars in the next year, their equity gets reduced. So you can claw back their equity. You can do that, correct? Yeah.
Yeah, the SBA, I think you'd have to do stock sale, if I'm not mistaken, if they roll over equity. But
Oh, yes, I see what you're saying. Sorry, I misunderstood what you're saying.
That's okay.
Yes, correct. Yeah, got it.
Fair enough. Thank you.
No problem. But you have to be very cautious with a stock sale because you can't step up the value of the assets again.
Right.
You got to take them for what they are if they're fully depreciated. And to some businesses, that could be an enormous hit. So you have to be careful about that.
Thank you.
My pleasure.
Just one question, Richard.
Yes.
Just on, since you touched on concentration, it's pretty common, maybe it's in more of a Canadian market thing because we're just small but what's your overall view in concentration? Like in terms of it, like a lot of deals I've looked at, concentration seems to be a recurring theme. With a customer typically, particularly when in the resources industry, which is in the West, it tends to be a recurring theme for the size of businesses.
Yeah.
Any thoughts around that in terms of what to look for, or if you have to accept it, or you just say, look, don't even bother, Cam, like you're just buying it. It's too much of a risk. I'm
It
happy
can
with
be.
no judgment.
Yeah, I mean, no, it could be. I mean, concentration could be a massive issue. So the way you want to do it is, I mean, and also it's important to define concentration, meaning is it with one customer or five? I mean, if you have 5 customers representing 70% of the business, that's actually entirely different than one customer representing 50, how it breaks down. So that's important. Some businesses, the nature of the business just have concentration. I mean, it's unavoidable. And so you have to determine whether or not you could live with that. What I always do is when there's an issue of concentration that I deem to be concentration, I do 2 valuations. So let's assume that there's an ordered amount of concentration, and some people peg it at 10, some people peg it at 20. I don't think there's a static number that you could say this constitutes a concentration. You have to look at it as far as the impact on the business for that particular concentration. And so the way I look at it is say, okay, I'm going to carve out that concentration. If all those customers stop buying from me, what is left with that business? What are the revenues? What are the profits to the best of my ability? So that's sample A, and then I add them all back in, and that's sample B. The delta between those two constitutes an earnout. So if you look at those customers, and if the business is going to make $1 million a year with all those customers in place, and it's going to make $600,000 a year with those customers gone, you have a delta, the difference of $400,000. The business, if you're paying a 3 times multiple, that earnout is 3 times the 400,000, so $1.2 million. So if the business, if you at $1 million, you're going to pay $3 million at a 3 times multiple. At 600,000, you would pay $1.8 million. The difference is $1.2 million. That constitutes the earnout. That's when how you structure it. And you always want to structure an earnout as easy as possible, usually based on revenue. You also want to do the exercise from the standpoint and say, hey, maybe in example A, at the business dropping, I can't make any money. Sometimes the concentration is so significant that if you look at the business without those customers, it's not worth buying. And you have to be, I've been in businesses with customer concentration, felt very comfortable. It's like the old theory, it's okay to have all your eggs in one basket, but you got to take real good care of the eggs. And so if those people start to, if people start to disappear, and you'll see that in distribution businesses, you also see it in Canada where people that are selling to major retailers, there's not many major retailers like there are. It's not, you're not able to diversify, but you got to be cautious because you have to come to the realistic understanding that business could decline, number one. The second thing is when you're negotiating with the seller, say, well, if customer A, B, and C disappear, your business is worth this. And they say, well, we're doing business with those people for 20 years. If customer A, B, and C disappears, because you probably don't know what the hell you're doing. So why should they be responsible? So it's a negotiation, but most importantly, it's you as the business owner have to be very, very comfortable with it.
Yeah. Okay. No, thank you. Thank you for your thoughts on that. It gave me some ideas around it.
Okay, good.
Hey, Rich, I had another one for you. So I think all of us deal with questionable ad backs and how to approach those discussions and questioning those. And in most cases so far, it's relatively small. Or if I'm talking directly to the seller about it, I feel like it's usually understandable. Right now, I'm dealing with one where it's a B2B. We talked about it, a B2B online e-commerce sales food service industry. So I submitted an LOI and the broker is kind of coming back, and I don't believe it's been presented to the seller yet, and kind of challenging me on my lack of interest in accepting the ad backs. And they're really kind of ridiculous. There's like something like we switched to a new marketing agency, and the new marketing agency is going to be much better. Therefore, you've adjusted all the prior marketing spend. Like,
is the new marketing agency charging less?
they're charging less, but we haven't seen results yet. They're like, oh, well, 4 years ago when we used them, they were better. So I'm like,
That's
the
not an
environment's
ad back.
changed.
That's not an ad back.
Yeah, so it's very absurd, and he's also some of his language in emails is like, if you want to be successful, you really need to accept our EBITDA or whatever. I'm like, so part of me is
No, I
like,
don't.
sure, I'll whatever you say the number is, I'll say the number. My multiple is now
See, the multiple will drop, right?
Yeah, but at the same rate, I feel like maybe with the seller, I'd be a little bit softer with it, but I feel like with the broker, and the fact that they haven't even presented it, it makes me kind of feel a little bit like it's just, you know, trying to pull out a bigger offer. He's also copying all of his senior partners on the email, so he's probably trying to look good,
Young broker.
Yeah.
Here's what I would suggest. Tell the broker, tell you what, for the purpose of the discussion, I'll accept all your ad backs. I'll accept all of them, but I'm going to go through them. I want to meet with the seller. We're going to go through them one by one and understand that if they don't make sense, we're going to adjust them out. So I'll take it. So it's no problem. I'll accept them all. Here's the multiple, here's the price, but understand if they're not, I want to sit in front of the seller. I want to understand these better and I like to do it like this. You know what? Maybe you're right. Maybe you're right. Okay. Like Mr. Smartass. Okay. Maybe you're right. Well, I'll take your ad backs. Here's my price. We'll sit down in front of the seller. And then if you're still not convinced, you can always adjust it in due diligence saying, I'm going to go through it, fine tooth comb, and then I'll decide. But you want to move it right now. The thing you don't want is you don't want the broker to be the impediment to the deal.
Mm-hmm.
And rest assured that when you sit in front of the seller, he's going to probably want to show how smart he is. And so just be prepared to deal with that. But the way I would avert that is to say to the broker, I'll accept all of them. I want to have a meeting with the seller and I want to hear it from the seller as to their rationale for these ad backs because it's their business. So, if the seller can explain to me properly why the marketing fund or the marketing expense should be an ad back because you can't. I mean, you weren't involved with the business when they decided to change marketing teams. So let me sit in front of the sellers. But for now, I'll accept all yours and let's have a meeting.
Great. Thank you.
Okay.
In absence of hands I see, can I ask another one?
Same price. Go ahead.
For a couple one, but one in particular, one that I found proprietary. They've been around for a long time. They had some rough times a couple years ago. It's actually kind of a sobering story because the owner at the time passed away, and I think the hard times of the business had something to do with it. The son now owns the business, and I think doesn't want to own it much longer. So from that perspective, it's a very logical time to transact. They did a lot of restructuring in the last year, and I've had a lot of use cases like where some of the ad backs, another one I'm talking about, like, oh, we got rid of that because we got rid of those people. You don't need them anymore. It's very hard not being in the business. Obviously, if I'm looking like, oh, I don't know if they're necessary. I mean, they might have been bringing in business. How do I know that? And are you just cutting a bunch of headcount to pump up the income before you sell? Should I even endeavor to figure that out now, or wait until due diligence and accept it for now? Like, because it's very hard to identify a data point that can help me prove one way or the other that those headcount were not necessary.
Yeah, it's a great question. And you get some people that they try to pretty up the business. If someone quits, they say, you know what, let's see if we can get along without hiring something new. Cause we'll save ourselves $75,000 for the year and we're going to sell it for a 3 times multiple. So, if we don't replace them, it's like 225 grand in my pocket. That's the owner's thinking, which is very flawed. But it is very hard sometimes to quantify those when there's changes. And it makes it extremely difficult for the buyer. And so I think if you really like the business model Okay. I think the way I would approach it is I would go back and look at when these expenses were actually in place. What does that business look like from a valuation standpoint? Okay. That's sort of your worst case scenario potentially. What does it look like now? Am I willing to pay somewhere in the middle for those? And am I willing to pay on the best case scenario? And then as far as speaking with the seller, saying it's similar to if certain things are obvious, then you've got to stand your ground. If other ones you just don't know because you don't have enough information, you got to wait till you dig in a little bit. Notwithstanding that, you may never know. And so in the cases where there's something dramatic where they cut out someone for 100 grand or a salesperson, whatever, in some of those cases, you may have to have a contingency in the deal related to what the effect of that departure is. In other words, if I determine after 6 months that person needs to be in place, I'm going to shave the earnings down by $75,000 less the earnings, less times the multiple, and your seller note drops by $225,000. If you can't get, and this is why a lot of people end up not getting to the finish line, because if you go through due diligence and you can't get a real good handle around that answer and you're uncertain, and it's not because you haven't done a good job, it's because you don't know. I mean, you got to be in the business. And so if on those things where you don't know about, you either have to solve for them in the price and terms, or you got to tell them I can't do it. But yeah, I mean, some things you just don't know, and so you've got to express that and say, "I'll wait till I get in due diligence." But you're right. I mean, there are times where they're putting lipstick on a pig, right? And they do some stupid things. They cut out marketing. I mean, and it's very possible that if this son has taken over the business, he doesn't want the business. It's almost like assured that they've done some of those things.
Yeah, I mean, in many respects, it's significantly better shape over the last 2 years. I mean, the things that I can verify are significantly better. He comes from a sales that, like he was in car sales and stuff like that. Just to give some context, it's a kind of a break fix technology, kind of with a retail footprint. Who's been trying to move into MSP, managed services for IT, for those that are not familiar, but pretty early in that. And he has a pretty good sales model and very good customer satisfaction. Like the reviews are wonderful. But I think the ability to they've had to cut a bit of cost, and they've reduced some stores that were not profitable. And I'm just trying to make sure. I think there's a big growth opportunity by maturing and getting proper MSP space. And I think it's kind of like access to MSP with Main Street prices. I think valuation is kind of my value prop here.
Yeah, the one thing that I could say with a high degree of confidence, people don't close retail locations unless they're really not performing.
Yeah,
I mean, it's easy to do that metric, and so because your whole reputation takes a bit of a shot, and so unless there's a better model, people are they're not closing locations that are doing well. It just doesn't happen.
For sure. Yeah. Thanks.
Yeah, of course. Oh, there's Yanal. Good looking Yanal. Okay. There you go. Hey, here's another one that came up this week, which was, and I saw this on Search Funder, and I told you with Search Funder, I sometimes read these posts and it's like I think people are taking crazy pills. So this whole thing came around the idea of the difference between EBITDA and seller's discretionary earnings. And the argument was that this seller is presenting seller's discretionary earnings, and they're adding back their salary. And it was like this individual went on to a rant, and it's like it reminded him of when two of my 4 kids were really little, and one started going crazy and the other one went crazy, and they're feeding off each other, and then they're both going bonkers, right? Like it was like just that back and forth between bad information between two parties, and then I think there was ultimately like 60 comments on this thing. And here's the reality. And one was making the argument, hey, I'm buying this business. No way I'm adding back the seller's salary because you need to put a manager into place. And they were trying to make that argument, and everybody was weighing in, and everybody, like they say about opinions, right? They're like butts. Everybody has one. So here's how you have to look at this. If you're looking at a business that is an owner operated scenario, in other words, the owner is operating in the business. They take their business to market as an owner-operated business. And therefore, they add back their salary. And that's where you get a difference between EBITDA and seller's discretionary earnings, because EBITDA is a debt-free managed business. Seller's discretionary earnings is an owner-operator, because they add back, you're basically taking the EBITDA and you're adding back the owner's salary and perks and personal expenses. If they are running an owner-operated business, and that's what they're selling, they are operating along the lines of seller's discretionary earnings, or what I call owner benefits. That's that number. You, or the community of buyers, if you want to add back managers and do that, that's your prerogative. And you can do your valuation that way. But that's not the seller's issue. That's you, the buyer's issue. Because they are bringing a business to market based on how it was run yesterday. Does that make sense to everybody? How you decide to do it, and you want to put a manager into place, or you want to look at, or you say, for example, they're making $500,000, but the seller, I got to go out if I want to, but I got to work the business. So I got to calculate based on, putting someone to place for 200,000. So it's only making 300. That's correct. But that's your exercise, the buyer. And that's your decision as a buyer as to want to run it that way. And that's your perspective as far as how you're looking at your return on your investment compared to putting it in the stock market or keeping your job. But understand, you can't get into a war with the seller or the broker saying that that's not correct, because they are correct in that instance. The business, that's how it was run today, is what they're bringing to market tomorrow. All those other adjustments or ways that you're looking at it, that's the buyer's perspective. And this individual, you could see that they must be up to 100 comments already, and everybody's got an opinion. It's just completely ridiculous. So understand that. And if anybody gets stuck when you start doing EBITDA or adjusted EBITDA or owner's benefit, reach out to me anytime. Joe, Big Joe. Okay.
Yeah. I guess along those same lines. So, never mind the managers, owner-operated business, the way I view it, and the way I've also had the same conversations with SBA banks, is they look at it as you have to still put in a salary for yourself. So from SDE, you're adjusting down. Is your suggestion to operate off of that SDE basis for, your purchase price? Or is it to say, well, accept your SDE, but I'm going down, therefore my price is coming down? Like, how does that kind of generally navigate it in the best way?
SDE without netting out your salary is how you value that business.
Say that a different way. Without netting out, how do you mean that?
Without reducing the SDE for your salary.
Okay, so keep it as the advertised SDE.
Yes, because now it may be incorrect, so you got to validate that. But that's the business you are buying. That's what you are getting. And
so if it was 3x, you're buying 3x.
Any alterations you make, that's on you. If you get lucky enough to say, I'm going to reduce it by 100 grand and use the same multiple, good for you. But the argument does not hold water. And I've been on both sides of the equation. Sorry, pal. You come back and say, well, you say 400,000, but I got to pay myself a salary. Well, there's 400,000 right there. That's part of that 400,000 is what you're going to pay yourself. And that's what you attach a multiple to, because it's what they are delivering. How you change it's up to you. It's the seller should not be penalized for that. Now, there are cases, of course, in ad backs where they're penalized, where they have someone that they're paying a family member $60,000 to do the financials, and they want to leave too, and it's going to cost you $100,000. You got to make that adjustment. But on straight SDE, assuming all is correct, there's no adjustment downward for salary that should weigh into your valuation to be of consequence to the seller. That's not their problem. That's your issue.
Okay. So then that's not a place where you can use the crutch of the SBA banks and say, they demand that I do that.
You could try, but I would tell you to go pound sand, right? As they say. Yeah.
Okay. I think I understand that. Definitely something that I've been looking at flawed. So appreciate that.
However, you bring up a good point, because the SBA, they will build something in and they'll establish a value. And then if the seller or the broker says, well, you can't do that, say, well, look, guys, it's not me that's doing it. These are the criteria for the lender. So if you want to get this loan, you want to get this finished, you want them to lend me the money, this is the way they've done their exercise. I mean, I can't go tell Wells Fargo to, to redo their algorithms based on your opinion. So that's, in that case, you certainly could, blame them, right? As we said. Yeah.
Hey, it's George. What I see is, and I agree with what you're saying in that the valuation should be based off the SDE. On the SBA side, what they'll do is subtract an owner's cost of living.
Yeah.
Call it 60K, 100K, maybe depending on where you live, to come up with a cash flow available for debt service. But that's different. I wouldn't look at that for valuation purposes.
Right.
That's just, is the cash flow of the business sufficient to pay the loan?
That's right. That's what they're looking for. Exactly. But that, even in that perfect example, as George said, that doesn't weigh into the valuation. It weighs into the underwriting of the deal.
Much better way of thinking about it, and definitely bridges a lot of gaps that I've had some challenges with. So, but I've also seen the flip side too, where the owner pays a lot and then you actually make up multiple in that way, which is helpful. But
yeah, exactly.
Okay. Thank you.
No problem.
Yanel's next.
There, I'm back with video on this time. So two questions I have. Maybe I'll go with the first one, a quick one, just to confirm, because I've been hearing conflicting information about this, some things I read and hear. If you do an SBA loan, can you still do seller financing? Like, can you do a combo loan? Okay.
Yep.
Okay. All right. Easy. That's an easy one. Second one, the other industries that I've been looking at, one of them is the e-commerce FBA space. Mainly why it's alluring to me, it's just like it could be done mostly at home, sometimes mostly remote. So, but it seems like there's a lot out there, which kind of scares me a little bit. There's a lot being sold out there, and I just wanted to, again, more high level, get your opinion on like this space. It seems like you get some like you could buy for $100,000 and some that you could buy for millions of dollars. So like there's a big wide range, and it seems like each one comes with its own challenges or headaches or opportunities maybe. So it seems like I have to like be very specific how I look at these and be very careful. So I'm not sure if you've had a chance to ever review any of these, and what are your thoughts on them or this space?
So I had a business that we did fulfillment by Amazon. It was in the shoe business. It's a very interesting concept, especially nice for individuals that, a lot of these individuals have gotten into the business for a much lower entry fee than they would have having to build something, because your distribution and fulfillment, I mean, it's a beautiful thing that Amazon provides. The whole world of Amazon FBA, for those of you that it's called fulfillment by Amazon, where they effectively, you ship them X amount of goods, they ship them out for you on your behalf. You ship them more than they need. But when you buy something from Amazon and it comes so quickly, it's because Yanal and his company, for example, they've sent them, 1,000 pairs of sneakers. You buy 2, they already have it in their warehouse. It's not a drop ship. It doesn't come from Yanal. It comes from Amazon already. It's similar to a drop ship in that regard. So, but Amazon takes title to the goods, they pay you for what they sell, etc. Just understand, that up until about 2 years ago, and you could look it up, Google it. I have a client who is or prospective client that has a business that does 90% with Amazon. There was a massive roll up in the fulfillment by Amazon world of companies buying all these Amazon companies. They weren't Amazon, all these people that were doing fulfillment by Amazon, because what their concept was the following, that they would buy all these companies, they would aggregate them, and they would benefit from their own internal systems and their order entry and billing and their marketing. They had some really good marketing, so they could build up, and it got very active for a while. You could look it up. That's the good news. The bad news is I think the 2 biggest players in that world went bankrupt. And I have the names here somewhere. They went bankrupt. A lot of companies raised a ton of money. The model just hasn't worked, that model of roll up. Okay. And so if you're going and buying it with this idea of saying, well, I'll just grow it a little bit and sell it to one of these companies, don't count on that. I do like I'll tell you why I really like these businesses. I like them from a standpoint for people to get into business. I mean, I really, you know, it provides an opportunity for people who may not have the confidence, the skill set, or the money to get into a business and get their life, you know, the world of entrepreneurship under their feet a little bit and get started. Because the most important thing is you want to get going. You've heard me talk about buy the biggest business you can afford to buy and feel comfortable operating it. But those type of businesses, they provide an entrance to entrepreneurship like none other, because the stuff that you tear your hair out related to business with marketing and fulfillment very often is taken care of. There are some risks because it could disappear. You want to make sure that you're good at a standpoint of keeping your rankings up high and want to understand that. But I do like these businesses where they're small enough that Amazon is not going to look at that and start knocking off your product, because that's what they do. As soon as a product is, as long as if it's not proprietary and you're selling gobs of it, then they just start making it on their own. And so these are small enough that doesn't happen. So I think there's some very good attributes to these businesses, but you want to make sure you're selling something may not be proprietary, but a little bit protected or exclusive, and understand why you're getting the orders. Because by and large, there's a lot of suppliers of every type of product. So it's in the marketing, the positioning, the search engine, or the optimizing of the product, the rankings that really play a role. So you got to get comfortable with that. But I really like these businesses, and especially for the last reason, because it gives people an opportunity to become business owners that they may not have had otherwise.
Thank you.
Richard, can I ask a follow-up on that? Wouldn't a type of business like that require, large amount of cash? I mean, if this is kind of why people go on Shark Tank, right? Is because you get to a point where you need so much inventory. Is this not similar in a way where you're trying to keep inventory in all these fulfillment centers?
Well, that's why I was talking. The ones that are smaller potentially won't have that problem. The ones that are larger will absolutely, because you have to stay on top of the inventory. The good news is Amazon pays well. They have incredible algorithms. They don't order ridiculous amount of excess. When I used to deal, and Cam, you realize that I don't know how long you live in Canada, but I used to be a huge supplier to Zellers. Right. If you were doing anything to them, they were like the Walmart of Canada. If you were doing any goods with them, I mean, there was one program that I did with them on consignment. They would order 10,000 and sell 100. They didn't care, because it was up to the vendor to stay on top of it. Amazon is really good that way as far as managing their inventory. Don't forget, they're in the real estate business. They're not in the retail business. They have to keep in their warehouse what's going to sell, because they're selling square footage in their warehouse. And so with other people, that may be the case, Irene, but with them, they manage it really, really well, so that because you're not sending them excess inventory, you're able to turn that inventory quickly. They do the turning, but you can turn it pretty quickly and able to buy it and sell it.
Yeah. I mean, I haven't looked at e-commerce, so this is all new to me. It's not an area that, is necessarily of interest to me, but it's fascinating to hear. It just seems like a catch-22, right? Because if you're trying to keep it small, you'll probably be small, right? Or if you're trying to grow and make more money, then it's going to take more.
You need more money.
Yeah.
Yeah, you're going to need more money. It's with Amazon, it's slightly different because they really manage it well. But make no mistake, there's still some lag period where you may, they're paying you as they sell it or reconciling at the end of every month. I would suspect that vendors, I know when doing the shoe business, we used to buy, our case was different because we bought everything for cash, meaning we went into manufacturers at the end of the season. All of the shoes, and Deja and Irene will especially appreciate it. So all of the shoes that you'd see at Bloomingdale's for $75 to $125, we went in towards the end of the season and bought out all the inventory that a manufacturer had and buy them for like nothing. Sometimes we buy them for $4 a pair because they had more shipments coming in, so they had to clean out their warehouse. We would sell them for $8.88 to $14.88. But in that case, we would never be able to get terms from our vendor because we were paying so inexpensively, because we were going in there and writing a check and buying 200,000 pairs of shoes, but we didn't get terms. Oftentimes, vendors that are supplying Amazon, if you could get terms from your vendors, which helps that, but it doesn't take away the.
Is that Richard freezing up, or?
It looks like Richard's freezing up.
Yeah.
At least he's frozen like in a really good position. But I see your comments. Richard, you froze her. for
Am I
a sec.
still frozen?
No, we can hear you now.
Did I freeze like this or something?
No, I was actually just saying you froze pretty decently.
Well, thank you, Alex. Thank you. I resemble that remark. Okay, so I don't know if you heard the end of it, Irene, but yes, you make a very valid point. As you grow, there is the potential, especially if you're not selling to the likes of Amazon, to require a whole lot of capital. Absolutely.
All right. So
How are we doing
differences-
for time, Sia?
We're looking pretty good. It's almost 5 till 4.
5 to 5 in Eastern Standard Time. Any last questions? Any comments, concerns, issues? We're good to go. I appreciate everybody's time. It's nice to see everybody. And
Richard, thank you. I just want to say thank you. This has been very, very informative, and I appreciate you putting this out. And I've learned a ton. So thank you very much for imparting that knowledge. And I love your energy. So thank you.
Oh, thank you. So not bad, eh, for a 62-year-old guy on a Friday afternoon.
Hey, I got some 22-year-olds that could probably learn something from you.
Yeah. Yeah. I tell people I'm 62 and a half. So, so next week we have a webinar in the part 3 of due diligence. These webinars that we're doing like this is strictly for our clients. We're going to continue to do those. I'm going to try to do them every 2 weeks. Does this time work for everybody for the most part? Because we have a lot of everybody's good with that. And so I think the next webinar is on a Saturday. We're just testing it, but we'll do these, keep these to our, to keep them to ourselves. I don't see any problem why I won't be able to continue to do them even through the summertime. Sometimes we'll have more people, some take less, but during the course of the week, everybody knows that if there's something that comes up and you have a question, you're always welcome to email me. If there's something that comes up or you come across an article or a deal or whatever that you think would be beneficial and everybody, the group will benefit, try to keep a note of it or throw it in a file because it's good to raise up, even if it's not a question that necessarily pertains to your exact situation. I think everybody benefits when we can share these ideas.
Thank you.
Have a fabulous weekend, everybody.
Thank you. Bye.